Krishnakumar, who is joining us on the show now, veteran fund manager. Krishna, thanks very much for joining us for your time. Which side of the argument would you lean on, given on the one hand how domestic inherently the flows, but now increasingly overseas flows are also good, but on the other hand, the recent rally in the month of December has been pretty sharp. KK, if you could just unmute yourself, please.
Sorry about that.
Yeah,
So
sure.
a couple of uncertainties are out of the way. One is, the state elections in the North India gave BJP a thumping victory and kind of removed uncertainties about the central elections in May 24, which now seem to be very much, in the bag of the BJP-led front. The second one was more global in nature, where the U.S. Fed kind of indicated a pivot and started talking about moderation of inflation, interest rates probably that have to come down by about 50, 75 basis points in the next 1 year and more. So this reversal and the interest rate cycle globally means that money is going to be available at a much lower cost, and you're going to see more risk on that will come through over the next couple of years. So these two major factors have removed some uncertainty from the markets, and a rally that could have happened in middle of 24 was held as is kind of already happened in December 23, thereby front-ending a lot of the all returns of 2024 in a way.
So you also, you're a numbers man. You always look at numbers more than narratives, right? So the narrative is that market is getting expensive, time to be cautious. Sure, the outlook must have improved on the factors you are saying, but numbers are not very supportive. Let's talk numbers. As things stand today, we are ahead of the earnings season. How do the numbers stack up? The reported numbers, on the back of reported numbers, valuation of Nifty, say 1 year forward and even 2 year forward, in your view?
Sure. I think definitely this year has been quite a bit of surprise, aided by expansion in operating margins. So Nifty earnings probably would be upwards of 1,000 rupees at this point for FY24. We are through December, and so most of it is in the bag. If you look at an FY25 and FY26, we are looking at least a 14 to 16% CAGR in earnings, basically. So if you run forward 1 year, 2 year earnings, we should be around 1,115 rupees on a 1 year basis, and about 1,280 rupees on a 2 year forward basis. And discounting the current multiples, Nifty, I think we get a multiple which is 2 year forward of about 17.5 times, right? So if you were to look at the return from a 1 year perspective, hence, I would probably expect the valuation to move to about 18.5, 19 times from here to December of 24, which means that your returns from here are about 6 to 8%, broadly speaking, from a 21,700 basis. Having said that, so we are a little expensive than norm, and there could be some time consolidation in the first half of the year, or some kind of a value correction also. So we should kind of bat for some kind of a consolidation in the markets at the headline number for a quarter or two before we kind of get some more steam. Having said that, I think the good things about India that we all know are there to stay, and we are definitely seeing incremental interest from foreigners and asset allocators moving money from other emerging markets like China into India. It is happening, and it will happen with a bit of a force going forward, because India is in a very good sweet spot that China was about 15, 20 years back. So we are in a kind of a secular growth of about 6-7%. Come what may, from a global perspective, the domestic economy is chugging along at about 6% at least. So this is going to be very good phase for India, and India could be one of the star markets of the next decade as we have been building out. So I think looking without looking at too much around the near term, investors should look at the next 3 to 5 years and look at healthy returns of 14-15% compounding, which is going to be very healthy.
Krishna, let's start talking about certain areas of the market which are not doing very well, because I'm assuming the margin of safety perhaps would be higher there. I was talking to Aarti Industries, Mr. Gogri, just a while back on the channel, and he said that it may take another 2 to 3 quarters for full destocking to happen in global markets, and margins could mean revert. I saw that their peak profits are 40% away from their current profits. Even their revenues are some 30-40% away from their peak, and hence no wonder the price of the stock price or valuation is also pretty off mark. Is it a prudent strategy to start approaching sector leaders in sectors which have not done very well in the last 3-4 years, for example chemicals?
I think one of the things that I probably would like to differ a little bit here is that the chemical space, the specialty chemical space, and the CRAMS, which were the kind of leaders in the last many years, there have been a lot of pressure points, as you mentioned rightly, and we are going through time corrections there. So valuations are still kind of stiff compared to the kind of earnings growth that they are showing at this point in time. So I think we need to be a little bit more stock specific in the space and look at companies where a lot more visibility of the next 3 years is in the bag. Definitely, a company like that you mentioned as a leader in that space would warrant look in. But I think we need to be more stock specific within the chemical space or any other sector which has been having a bad time in a couple of years, whether they have enough wherewithal to kind of get through the next 3 years with good growth, basically. So I think a lot of valuation is already built into these stocks, basically.
Where else, KK, do you see a good margin of safety in this market, or where you would want to be a buyer if the prices come lower by 10-20%, given that the structural earning drivers are in place for next 2-3 years?
Yeah. So if you look at areas where on a relative price to book and other old school valuation multiples, things are better, I would bet on some of the areas in the consumer discretionary, right? I think consumer durables, building material, home improvements have been spaces where the next couple of years we'll see very substantial growth, and we would see the benefits of also margin improvements coming through as demand situation improves. So typically, when in a real estate cycle, the building materials and other home improvement products come in a little late on the completion of projects, and I think we're going to see an explosive growth in the building materials space. On consumer durables, I think they have had about 2 bad years, and stocks have been on a corrective mode, both AC and non-AC consumer durable companies, and we should be looking at them selectively to get invested. On the other question of what would we buy when stocks correct 20%, I think a huge amount of traction from an order book perspective and build out in the next 3 years is in the industrial space. If you look at all the engineering goods companies and capital good companies, they have had a tremendous run in the last 1 year, and valuations are looking quite full and expensive. So the visibility of growth for the next 5 years is extremely good. So any correction in the capital goods engineering space, I think, is somewhere where I would like to advise people to put money in, basically.
Mm-hmm. Okay, before I let you go, I'll take a view which more on an outlook 2024, or maybe a little further as well. Increasingly, a lot of global agencies have upped their India growth estimate guidance. In fact, our own RBI governor did the same, and now he sees 7% kind of economic growth. Global other agencies are saying that in the next 7, 8, 9 years, by turn of the decade, we may be the 3rd largest economy globally. I want to understand is that if there is longevity in economic growth and the visibility on that, worst case 5.5%, 6%, best case 7, 7.5%. Do you think corporate earnings also have that visibility, or corporate earnings in India actually will follow a deeper cycle, upward or and on the downward, irrespective of where the GDP growth is?
I think to a large extent, there is still a lot of cost optimization levers available in Indian companies, and with benefits of operating leverage, there will be substantial improvement in margins also. So, whether it's a 5% or a 7% kind of a GDP growth with a 3-4% inflation, with nominal growth about 10 to 11%, I think the profitability would go between 14 to 20%, depending upon different companies on a compounded basis, depending upon how efficient they are already and how efficient they can get going forward. So I think it's a great space in terms of Indian equities to be in, and from a long-term perspective, I think we need to be there and be prepared for time corrections here and then. So that's going to be part of investing, and that we are seeing already. And even in a big bull market, we will have substantial corrections of 8-10% happening every year across the next 5 years also. But I think the point is to be invested and ride the growth in earnings and compound your wealth by about 15%.
Right. All right, KK, always enjoy our conversations. Thank you so much for your time today as well.
Thank you, Ajay.
That is Krishnakumar, Krishnakumar of Lion Hill Capital, veteran fund manager as well. Take a short break, come back.